81. That's the number. $81 per ounce. That's where silver settled after dropping 11.2% in 3 trading sessions, the fastest 3-day decline in dollar terms in silver's recorded history, the largest single-week liquidation event in COMEX silver futures since March 2020. Every headline is telling you the same story right now. Silver crashes, bubble bursts, retail gets trapped. The narrative flipped in 72 hours from universal euphoria to universal panic. The traders who bought at $90 are liquidating. The analysts who published $100 targets 2 weeks ago are revising downward. The sentiment shift is total, and not a single headline, not one, has mentioned what happened inside the COMEX vault system during those same 3 trading sessions. Not the price, the metal. Because while silver's paper price dropped 11.2% from $91.20 to $81 registered COMEX inventory, the metal contractually earmarked to fulfill delivery obligations on active futures contracts declined by 9.4 million ounces. Not eligible inventory, not total vault holdings, registered, the metal that backs the promises. The price crashed. The metal left. Those 2 things are not supposed to happen at the same time. In a functioning market, a price crash reduces delivery demand. Fewer participants stand for delivery when the price is falling because they can buy cheaper on the open market. Registered inventory should stabilize or increase during a sell-off as delivery pressure eases. It didn't. It accelerated. 9.4 million ounces in 3 trading sessions. That is a drain rate of 3.13 million ounces per session. The previous record single session drain was 1.8 million ounces in February 2021. That record has been broken 3 consecutive days. And here is the number that makes those 9.4 million ounces existential. COMEX registered silver before this crash, 68 million ounces. After the drain, 58.6 million ounces. Open interest convertible to ounces, 740 million ounces. Coverage ratio before the crash, 9.2%. Coverage ratio after the crash, 7.9%. The coverage ratio didn't just stay in the danger zone during the crash, it fell deeper into it. The March delivery cycle, the most active delivery month in silver futures, is processing right now, and the metal that is supposed to back those deliveries is leaving the vault faster than at any point in COMEX history. Read that again. Record vault drain. During a price crash, during the most active delivery month of the year, the price says silver is falling apart. The vault says silver is being pulled apart. One of those is the story, the other is the truth. Everything I'm about to show you comes from COMEX daily vault stock reports, CFTC commitments of traders data, CME group delivery notices for the March 2025 contract cycle, CME margin requirement bulletins, and historical delivery records from the London Bullion Market Association and the Shanghai Futures Exchange. Not sentiment, not technical analysis, not price charts, delivery data, the metal moving in and out of vaults that you can verify on the CME Group website before this video ends. By the end of this video, you'll understand why registered inventory declining during a price crash is the single most important signal in commodity markets. You'll see the 3 previous times in the last 25 years when a major commodity experienced a double-digit price decline while delivery cycle data simultaneously showed accelerating physical demand. You'll learn what happened to the price in every case within 90 days, and you'll understand exactly why the March delivery cycle breaking in real time means the $81 price is not a destination. It is a mechanism. The market cipher framework tracks a specific pattern I call the delivery cycle fracture sequence. It identifies the precise mechanics by which a commodity price crashes on paper, while the physical delivery system simultaneously shows accelerating demand, and how that contradiction resolves. It happens in 4 stages. Stage 1. The momentum phase. The commodity has been rising, bullish sentiment is extreme, speculative long interest is elevated, prices hit levels that attract media attention and retail participation. The rally is real, supported by fundamentals, but the pace has attracted momentum capital that is vulnerable to reversal. Open interest is at or near record levels. The market feels invincible. This is when the setup loads. Stage 2. The margin reset. The exchange raises margin requirements. This is the mechanical trigger. Higher margins force leveraged long positions to either deposit additional capital or liquidate. Most liquidate. The liquidation cascades through the order book. Algorithms detect the selling pressure and amplify it. Stop losses trigger. Forced selling produces more forced selling. The price drops 8% to 15% in days. Headlines scream crash. Sentiment inverts completely. Stage 3. The delivery fracture. This is where the contradiction is exposed. Despite the crashing price, participants in the active delivery cycle do not abandon their delivery requests. Industrial consumers who need the metal do not care that the paper price dropped 11%. They need silver for manufacturing lines that cannot stop. They stand for delivery, Registered inventory declines during the crash instead of stabilizing. The coverage ratio compresses further at the exact moment the market believes the crisis has passed. The crash was supposed to relieve pressure on the delivery system. Instead, it intensified it. Because the crash was a paper event, the demand was physical, paper and physical just separated. This is where silver is right now. Stage 4, the resolution. The exchange faces the same choice it always faces when paper and physical diverge beyond reconciliation. Deliver the metal and validate the higher price, or change the rules, restrict delivery, settle in cash, and confirm that the paper market has lost its connection to physical reality. Both outcomes produce higher prices. Delivery validates the bull case directly. Rule changes validate it indirectly by proving the system cannot function at current prices. The price that was supposed to crash stays elevated or goes higher. The mechanism failed. The metal won. Let me show you the 3 times this exact pattern has played out in the last 25 years. The sequence repeats with mechanical precision. Event 1, COMEX Gold, March 2020. Between March 9th and March 19th, 2020, gold crashed from almost $680 to $171 per ounce, a 12.4% decline in 8 trading sessions. The COVID liquidity crisis forced leveraged participants across every asset class to liquidate. Gold was not spared. Margin calls and equities forced gold longs to sell to raise cash. The paper price collapsed. But the March 2020 delivery cycle told a completely different story. Standing for delivery on the COMEX April gold contract surged to over 31,000 contracts, representing 3.1 million ounces. This was the highest delivery demand in COMEX gold history at that point. Registered gold inventory declined by 1.2 million ounces during the price crash. Not after, during. The metal was leaving vaults while the price was falling. Physical premiums on gold bars in London exceeded COMEX spot by $70 per ounce, the widest premium in decades. The LBMA COMEX spread blew out because physical buyers were paying dramatically more than the futures price for actual metal. The exchange responded by creating a new 400-ounce delivery contract to alleviate the stress on the standard 100-ounce contract. They changed the rules, not because the market was functioning, because it wasn't. Within 5 months, gold rallied from the $1,271 low to $2,075 per ounce, a 41% gain. The crash that was supposed to end the bull run became the launch pad for the move to all-time highs. The delivery data told you the crash was paper. The price confirmed it within 90 days. Verdict: gold crashed 12.4% on paper liquidation. Registered inventory declined during the crash. Delivery demands hit record levels. Physical premiums exploded above futures prices. The exchange changed contract specifications to manage delivery stress. Price rallied 41% within 5 months. The delivery data was the truth. The price crash was the lie. Event 2, NYMEX Palladium, January to March 2001. Palladium had rallied from $200 to over $1,090 per ounce through $2,000 on Russian supply disruptions. In January 2001, NYMEX raised margin requirements 3 times in 6 weeks. Palladium crashed from $1,090 to $620 per ounce, a 43% decline. The headlines declared the palladium bubble over. Analysts published targets below $400. Speculative interest collapsed. The narrative was unanimous. But NYMEX delivery data showed something entirely different. Despite the 43% price crash, participants standing for delivery on the March and June contracts did not decline. Industrial users, primarily automotive catalytic converter manufacturers, continued demanding physical metal because their production lines required it regardless of price. NYMEX registered palladium inventory, already critically low at 30,000 ounces before the crash, continued declining through the decline. It fell below 20,000 ounces. The exchange began experiencing delivery delays. Participants who stood for delivery waited weeks for metal that should have arrived in days. Ford Motor Company, unable to secure reliable delivery through the exchange, signed a $1 billion forward purchase agreement directly with Russian suppliers. The exchange had become unable to perform its primary function, delivering metal to buyers during a price crash. The crash was supposed to fix the problem. It proved the problem was unfixable. Palladium never returned to the $620 low. Within 18 months, it stabilized above $800. Within 3 years, the delivery infrastructure had permanently shifted away from the exchange toward bilateral agreements. The exchange lost its relevance not during the rally, but during the crash, when it could not deliver the metal buyers demanded at any price. Verdict: palladium crashed 43% on margin increases. Delivery demands persisted through the entire decline. Registered inventory declined during the crash. The exchange experienced delivery failures. Industrial buyers bypassed the exchange entirely. The crash did not resolve the physical shortage. It exposed it. The delivery data was the truth. The crash was the mechanism that proved the system could not function. Event 3. COMEX Silver, January to February 2021. Silver rallied from $25 to $30 per ounce in the last week of January 2021 on the retail-driven squeeze. CME Group raised margin requirements on February 1st. Silver dropped from $30 to $26.10 over the following 2 weeks. A 13% decline. The narrative was definitive. Squeeze failed, retail got crushed, silver is going back to $22. Every major financial outlet declared the silver trade dead. The February 2021 delivery cycle said otherwise. Standing for delivery on the March COMEX silver contract reached 17,000 contracts, the second highest March delivery demand in a decade. COMEX registered silver inventory dropped from 152 million ounces to 128 million ounces in 6 weeks, a 24 million ounce drain. During a price decline, physical dealer premiums on 1 ounce silver coins reached $8 to $12 above spot. Multiple major dealers, including JM Bullion and APMEX, imposed quantity limits and extended delivery timelines to 4 to 8 weeks. The physical market was screaming shortage, while the paper market was declaring defeat. Silver bottomed at $26.10 and within 4 months traded above $28.50, eventually reaching $30 again by May. But the real story was the registered inventory. It never recovered. The 152 million ounces of February 2021 became the high watermark. Registered inventory has declined almost continuously since reaching the 68 million ounces recorded before this current crash. The delivery cycle fracture of February 2021 initiated a structural drain that has not reversed in 4 years. Verdict. Silver crashed 13% on margin increases. Delivery demands during the February-March cycle hit decade highs. Registered inventory declined by 24 million ounces during and after the crash. Physical premiums disconnected completely from futures prices. The crash did not relieve delivery pressure. It initiated a 4-year drain that has brought registered inventory from 152 million ounces to 58.6 million ounces today. The delivery data was the truth. The crash was the beginning, not the end. 3 events. 3 double-digit price crashes during active delivery cycles. 3 cases where registered inventory declined during the crash instead of stabilizing. 3 cases where delivery demands persisted or accelerated despite falling prices. 3 cases where the price recovered and ultimately exceeded the pre-crash level. The pattern is absolute. When the delivery cycle fractures during a price crash, it means the crash is a paper event and the physical market has separated from the price mechanism. The paper market is liquidating. The physical market is accumulating. These cannot coexist indefinitely. The physical market wins every time. Because margin calls can force a leveraged trader to sell a futures contract. They cannot force an automotive manufacturer to stop needing palladium. They cannot force a solar panel factory to stop needing silver. They cannot force an industrial consumer to stop standing for delivery on metal their production line requires tomorrow morning. The crash clears the paper. It does not clear the demand. And when the paper clears and the demand remains, the price recovers into a market with less inventory than before the crash began. The crash doesn't solve the shortage. It deepens it. Every ounce delivered during the crash is an ounce no longer available for the next delivery cycle. The liquidation event that was supposed to relieve the system instead drained it further. So let me show you exactly what the March delivery cycle data says right now as of this recording. Silver crashed from $91.20 to $81 in 3 trading sessions. CME Group raised initial margin requirements on COMEX silver futures from $16,500 to $21,000 per contract on March 12th, a 27% increase, the largest single margin increase since February 2021. Open interest declined by 38,000 contracts in 3 days. That is leveraged long liquidation, forced selling, margin calls converting positions into market sell orders. This is the mechanical cause of the 11.2% price decline. Not a change in fundamentals, not a change in supply, not a change in demand, a change in margin requirements that forced leveraged participants to exit. But here is what happened simultaneously in the delivery system. Standing for delivery on the March COMEX silver contract, as the first notice day reached 14,200 contracts representing 71 million ounces. That is the highest March delivery demand in COMEX silver history. Registered inventory before the crash, 68 million ounces. Standing for delivery, 71 million ounces. Read those numbers again. More ounces are demanded for delivery than exist in the registered category. The March delivery demand exceeds 100% of registered supply, not 86%, not 50%, over 100%. Registered inventory has already declined to 58.6 million ounces, as 9.4 million ounces were delivered in the first 3 days. At the current delivery pace, registered inventory reaches 0 in 18 trading days. Not months, not years, trading days. The coverage ratio against total open interest is 7.9%. Against March delivery demands alone, it is negative for the first time in COMEX silver history. The delivery system is not under stress. The delivery system is mathematically unable to fulfill the obligations currently standing against it without either sourcing new metal or changing the rules. This is stage 4 of the coverage ratio collapse sequence I detailed in my previous video. The default threshold has been crossed during a price crash. That combination has no precedent. Shanghai silver premium over COMEX has widened to $4.20 per ounce. Physical dealer premiums on 1,000-ounce bars are 8.1% above spot, the widest since March 2020. Delivery delays from major dealers have extended to 3 to 6 weeks. The physical market is not crashing. The physical market is paying more, waiting longer, and demanding more metal than at any point in the current cycle. The paper price says $81. The delivery system says there isn't enough metal to fulfill March obligations. The premium structure says physical buyers are paying $87.50 in real terms when premiums are included. 3 data streams. 2 say the price should be higher. 1 says it just crashed. The one that says it crashed is the one controlled by margin requirements set by the exchange. And margin requirements are not market forces. They are administrative decisions made by the same exchange that is struggling to deliver the metal its contracts promised. The exchange raised margins. The price crashed. The delivery demands didn't. That tells you everything you need to know about what the crash is and what it isn't. Now I know what you're thinking. Silver ran from $30 to $91 in less than a year. An 11% pullback is healthy, normal, expected. Every parabolic move corrects. This is the correction. The fundamentals haven't changed, but the price got ahead of itself, and now it's recalibrating. The delivery data is interesting, but delivery demands always spike during volatile months. It doesn't mean the system is breaking. It means the system is busy. And you're partially right. Corrections after parabolic moves are normal. An 11% pullback within a larger uptrend is not inherently alarming. If registered inventory had stabilized or increased during this pullback, if delivery demands had moderated, if physical premiums had narrowed, I would agree with you completely. That would be a normal correction within a bull market. But that is not what is happening. Registered inventory is declining at the fastest rate in COMEX history. Delivery demands exceed registered supply for the first time ever. Physical premiums are at 4-year highs. Every metric that should normalize during a healthy correction is instead accelerating in the direction of delivery failure. A healthy correction relieves pressure. This correction is increasing it. A healthy correction sees inventory rebuild as speculative demand cools. This correction sees inventory draining faster as industrial demand ignores the paper price entirely. When the correction behaves like an acceleration of the underlying stress rather than a relief of it, it is not a correction. It is a fracture. Here's what this means for you, specifically, starting right now. First, watch COMEX registered inventory daily. It stood at 68 million ounces before this crash. It is now 58.6 million ounces. If it falls below 50 million ounces before the March delivery cycle completes, the exchange will face a binary choice between delivering metal it may not have and implementing emergency rule changes. The 50 million ounce level is your threshold. The CME publishes vault stock reports every business day. Track them. Second, monitor the March delivery pace. CME Group publishes daily delivery notices showing how many contracts were delivered, how many are still standing, and how many were issued versus stopped. The current standing for delivery figure of 14,200 contracts against 58.6 million registered ounces is the number that defines the next 3 weeks. If standing for delivery remains above 10,000 contracts through March 20th, the delivery fracture is confirmed. Third, track margin requirement changes. The CME raised margins from $16,100 to $21,000 on March 12th. If they raise again before the March cycle completes, it is not risk management, it is delivery management. Additional margin increases during an active delivery cycle where registered inventory is insufficient are the exchange trying to reduce delivery demand by making it more expensive to hold contracts through to delivery. Watch for the second increase. It is the confirmation signal. Fourth, compare physical premiums to spot daily. The current 8.1% premium on 1,000-ounce bars means the physical market is pricing silver at $87.50, while the futures market prices it at $81. That $6.50 gap is the delivery fracture expressed in dollars. If that gap widens to $10 or more, the physical and paper markets have functionally separated. At that point, the futures price is no longer the price of silver. It is the price of a promise that the delivery data says cannot be kept. Fifth, understand what you own. If you hold physical silver, you hold the metal that 14,200 contracts are currently demanding, and that 58.6 million registered ounces cannot fully supply. If you hold paper silver, you hold a claim on a system that is delivering 3.13 million ounces per day from a pool that runs empty in 18 trading days at that pace. The paper crashed to $81. The metal didn't crash anywhere. It moved from vaults to buyers. It didn't lose value. It changed hands. Know the difference. Subscribe to the Market Cipher and turn on notifications. The next video will track the March delivery cycle day by day, showing you the exact drawdown in registered inventory, the number of contracts still standing for delivery, and whether the exchange implements emergency measures to manage the fracture. I'll show you the specific delivery notice data, the specific vault movements by depository, and the specific rule changes that signal the exchange has moved from monitoring the situation to managing it. Here's what the data shows. Silver's paper price crashed 11.2% from $91 to $20 to $81 on a 27% margin increase. Registered COMEX inventory declined by 9.4 million ounces during the crash, the opposite of what should occur during a correction. March delivery demands of 71 million ounces exceed registered inventory of 58.6 million ounces for the first time in COMEX history. The coverage ratio has fallen to 7.9%. Physical premiums have widened to 8.1% above spot. 3 historical precedents where delivery data contradicted a price crash, gold 2020, palladium 2001, silver 2021, all resolved with prices recovering and exceeding pre-crash levels. None resolved with the delivery data being wrong. The price crashed because the exchange raised margins. The delivery data accelerated because industrial consumers do not respond to margin requirements. They respond to manufacturing schedules. The margin increase cleared the paper. It did not clear the demand. The paper is gone. The demand is standing in the delivery queue right now. Drop a comment below. Tell me what premiums you're seeing on physical silver today. Tell me what delivery times your dealer is quoting. Tell me whether your broker raised margin requirements on silver this week and by how much. Every data point from every market participant in every region builds the picture. I read every single comment. Silver crashed to $81 on paper. Registered inventory crashed to 58.6 million ounces in metal. One of those crashes is a margin event that reverses when the liquidation exhausts itself. The other is a structural drain that has been accelerating for 4 years and just hit a record pace. The paper recovers. The metal doesn't come back. It was delivered. It's in a factory. It's being soldered into a solar panel or etched into a circuit board right now. It's gone. Thanks for watching the Market Cipher. And remember, the exchange can change the margin requirement. It cannot change the amount of metal in the vault. The margin increase created the crash. The delivery data tells you the crash is a paper event. 71 million ounces standing for delivery. 58.6 million ounces in the vault. The math doesn't work. And unlike margin requirements, math is not an administrative decision. See you in the next one.